What if you could use property to passively invest in different asset classes? Property is considered a long-term stable investment in the UK, but what if you're on the sidelines thinking about alternative asset classes? Could you use the rental income to passively build wealth across those asset classes while still owning property assets? How would that work? What would you do? What are the steps to take? And could this accelerate your wealth creation? So the video is broken down into 3 parts: director and intercompany loans and how to use these effectively, the numbers and how they look over time, and a brief history lesson about investing in property as well as additional asset classes over the last 20 years. Now, if you're new to my channel, hi, I'm Jonathan. I founded SPV Mortgages, which is a specialist finance brokerage around 6 years ago. We've helped hundreds of property investors start and build successful portfolios over that time. My channel is all about the experiences I have with them, sharing them with you. Now, if you're a high rate taxpayer in the UK, more than likely you're going to be investing in property via an SPV limited company, which is a limited company set up specifically to purchase property assets. But there are 2 ways to fund an SPV. One is director loans and the other is intercompany loans. Okay, so let's start with director's loan. So a director's loan is essentially money that's sitting in your personal bank account, which you move over to the SPV bank account. Now, from a tax perspective, HMRC consider the money sitting in your personal bank account already taxed, which means that when you pull the money out as a repayment of a director's loan, it's tax-free. For example, let's just say that you're sitting on a pot of money in your personal bank account of £250,000, 250 grand. You move the 250 grand from your personal account into the SPV bank account, and then over time, you withdraw the rental profits from your SPV as a repayment of a director's loan. That money that then sits in your personal bank account could be invested in alternative asset classes. Now, intercompany loans work slightly differently. So you have a trading business on one hand, you have the SPV on the other side. The trading business has retained profits, so cash in the bank account, which is not subject to tax. You've paid the corporation tax bill. You move those monies from the trading account into the SPV bank account, you bypass dividend tax. So if you've got, for example, £250,000 sitting in your trading account, you can move the 250 grand from that business account to your SPV business account tax-free. Then what would happen, very similarly to director's loans, is that when the rental profits come in and obviously the SPV has paid the tax, you pull out the retained profit as a repayment of the intercompany loan from your trading business, and then your trading business can invest in, for example, a pension plan, which is linked to an alternative asset class. Now, regardless if you're employed or self-employed, it makes no difference. You can still fund an SPV in a very tax-efficient way, but most importantly, you can withdraw the profits from the business in a tax-efficient way. Those profits can then be utilized to invest in alternative asset classes, which perhaps are a lot more unstable than property assets. For example, they might be, crypto funds, you might be investing in the money markets, you might be looking at bonds or equities, something which historically has a lot of volatility, but perhaps might have greater gains over a longer period of time. So let's say you have £150,000 sitting in your personal bank account. You move that into the SPV and the SPV invests that in a property. That property generates £2,000 in rental income, so around 6%. The interest rate on the mortgage at 75% loan to value is around 5%, which means that your net profit after 19% corporation tax should be around £200, give or take. That £200 you can pull out as repayment of a director's loan or repayment of an intercompany loan, which you can then invest in an alternative asset class, which perhaps has much higher volatility than property assets, but at least 150 initial investment remains stable because it's sitting in a very stable investment class, that being property. If we compare this to the likes of investing in a different asset class, let's call it the S&P 500, which has a dividend rate of between 1% and 2%, the figures change very slightly. So let's just say that you invested £150,000 in the S&P 500. That has a dividend rate of 2%. That means that gross, you'll be receiving £3,000 per year. Now, if you wrapped the investment within an ISA, and of course you can't do that with £150,000 lump sum, but over time you can, but let's just say you're in a very tax efficient ISA and you're not paying any tax, the gross income for you per month would be £250, which is slightly higher than the net return that you would get from a property. However, with the property side of things, that has included tax. We're not taxing obviously the S&P 500 just for illustrative purposes. So here's where things change. So over the last 20 years, so between 2003 and 2023, property prices in the UK have risen on average around 5%. Now there are some changes in regards to geographical area, but overall it's about 5%. the S&P 500 has returned 10% per year over that period of time. So here is the value of both assets if you invested 150k in 2003. So if you bought a property for 425 grand with a 5% return, that would mean that the value over 20 years would increase to £1,127,651. Now, if we then take off the debt, which is 75% of 425 grand at the time that you purchased the property, you're left with a gain, including the 150,000 initial investment, of £1,021,401. Now, if we compare that to the S&P 500, you've invested £150,000 day one, you've got a 10% return on average over 20 years, meaning that the total amount of the fund value would be £1,009,124. So you can quite clearly see there's not much in it in regards to property versus the S&P 500 over that 20-year period. But if you were to own a property and then took the rental profits from that property and then distributed them within an S&P 500 fund, what do the figures then look like? So once again, we have a property worth 425 grand day one. It's got a 5% growth rate over the last 20 years, meaning that the value as of today would be £1,127,651. So net gain of £1,021,401. Now, if you had invested in the S&P 500 at £200 per month, day one of owning the property with a 10% gain, that would equate to £153,339. So the total investment value would be £1,174,740. So this tells us that historically it's a good idea to diversify your asset base to create long-term wealth. And although history will not tell us exactly what will happen in the future, it's a good guide to provide some level of comfort that obviously these asset classes, they both rise over time. Now, what's interesting about the numbers that you've just seen is that I haven't factored into account that rents rise over a period of time. Now, in the UK, historically, over that 20-year period between 2003 and 2023, rents increased 3.7%, which means in reality, every year when you have that rent review with your tenant, if you are in a position to push up the rents because market conditions have changed, you'll have more money to invest in alternative asset classes, meaning that if you were to purchase a property and then take the rental profits from that property to invest in different asset classes, you could be creating even more wealth than what we've shown on the video. If diversifying into different asset classes is not really your thing and you're laser focused on investing in property and making money in the property market in the UK, then I would recommend watching this video.